Ladies and gentlemen, good day and welcome to Q2FY25 earnings conference call of Saksoft Limited hosted by Monarch Capital. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vinay Menon from Monarch Network Capital. Thank you and over to you, sir.
Yes, thank you, Muskan. Good afternoon, everyone. On behalf of Monarch Network Capital, it's my pleasure to host the senior management of Saksoft. We have with us Mr. Aditya Krishna, CEO of the company, and Mr. Neeraj Kumar, the CFO and COO of the company. I will now hand the call to Mr. Aditya Krishna for his opening remarks. Then we'll move to Q&A. Thank you and over to you, sir.
Thank you, Vinay. Hello and good afternoon, everyone. Welcome to our earnings call to discuss the performance of the second quarter and the first half of FY25. Let me start off by briefing you on the key business highlights for the second quarter, after which my colleague Neeraj, our Chief Operating Officer and Group CFO, will brief you on the financials. As you're all aware, the IT sector has been facing severe headwinds globally. Despite these, I'm pleased to report that we managed to report good growth during the quarter and half year under review. We have reorganized our business into 4 high-growth business units, making us more market-facing and customer-focused. These business units are FinTech, High-Tech Media and Utilities, Transport and Logistics, and Retail E-Commerce. Each business unit is now being headed by a leader responsible for ensuring that the company stays abreast of market trends and disruptions, as well as for revenue and margin growth. In addition, this chain will help us differentiate our offerings as a digital specialist based on domain in a fast commoditizing industry. Our realignment of business into focused verticals is on the back of our strategy and results obtained in the past thereof. We believe that the more we focus on verticals, the more we grow as a business as we become more market-facing. These verticals will be continued to be supported by our horizontal service offerings spanning data, analytics, cloud solutions, legacy modernization, intelligent automation, product application engineering, and quality assurance. On business updates, the number of clients with annual spending exceeding $1 million has grown from 15 to 17. We have added 2 new clients in the $1 million category within the high-tech media and utilities vertical, thanks to our previous acquisition of Augmento, which facilitated the addition of these new customers in this sector. In September 2024, the company made another acquisition of Saksoft Software Private Limited, which is a global Salesforce service provider that enhances the value of customers' Salesforce investment through consulting, digital transformation, and innovative solutions. We are pleased to inform that the allotment of bonus shares has been completed in this quarter. The current quarter, the board has also announced an interim dividend of 40 paisa, that is 40% of face value of rupees 1 fully paid up shares on the post-bonus share capital. Now, I would request Neeraj to give you the financial highlights for the quarter under review.
Thank you, Aditya, and thank you everyone for taking the time and joining our earnings call today to discuss the results of the second quarter and half year ended of the financial year 2024-25 under review. For the second quarter of financial year 2025, the revenues reported were at around INR 215 crores, representing a growth of about 13% year on year. The EBITDA stood at INR 37 crores, which grew by around 3% year on year, with the EBITDA margins being at 17.08%. The net profit for the quarter was around INR 26 crores, which grew year on year by 4% and 2% quarter on quarter. with the profit after tax margins being at 12.15%. For the first half of the financial year 2025, the revenues reported were at INR 416 crores, representing a growth of around 11% year-on-year. The EBITDA stood at INR 72 crores, which grew by around 2% year-on-year, representing an EBITDA margin of about 17.25%. The net profit was at around INR 52 crores, which grew year-on-year by 3%, and the PAT margins being at 12.43%. Now coming to the revenue split by geography for the first half of the current year, the USA contributed 43% of our total revenues, Europe contributed 23%, while the remaining 34% came from Asia Pacific and other regions. The on-site revenue mix was 45% and offshore is at 55%. The revenue split across verticals for the current half of the year is as follows. Fintech contributed about 31% of our overall revenues. High-tech, media and utilities contributed 42%. Transportation and logistics contributed 16%. And the last, retail e-commerce contributed to 11% of our total revenues. The total employee count at the end of the quarter stood at 2,292, out of which 2,069 were technical, with the utilization of the employees excluding trainees being at 84% for the first half of the current year. Moving to the balance sheet as of 30th September, the net available funds with the company were at INR 150 crores. That concludes the update on the quarter, and we can now open the floor for the Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question is from the line of Meet Raj from Equirus PMS. Please go ahead.
Yeah, thanks for the opportunity. First question is in terms of revenue growth for this quarter. So if I look at the organic growth, excluding the recent acquisitions, revenue growth seems to be kind of flattish on QOQ as well as YOY basis. So is my understanding and calculation correct? And if yes, then what led to this subdued performance in Q2 on organic basis?
The acquisition of Augmento contributed about 8 crores. How much?
The incremental for the quarter was 8 crores.
Incremental for the quarter was 8 crores. So between 215 and 202, so we grew by 13 crores. So the organic growth was 5 crores. Yeah.
On QOQ basis.
Yeah, on a quarter-on-quarter basis. I think that's more relevant. So we are trying very hard to increase the growth rate. It is, we are seeing signs of increased momentum. We are seeing signs of increased activity in our sales pipelines. And it will take us some time, but we'll get there. And it's difficult, in a market which is commoditizing. It's difficult with these headwinds in the US market, which is our biggest market. So it's been tough, but I'm not saying it's an easy task, and your question is very pertinent. At the end of it, with the same capital, we have grown, whether it's through acquisition or organic. Both are growing organically as well as inorganically, and that's going to be a strategy going forward.
Okay. And related question in terms of our vertical-wise revenue. So if I look at the first half FY25 vertical-wise growth, Then fintech and transportation and logistics verticals seem to have declined by 9-10% each on a YOY basis, first half to first half. So just trying to understand what are the demand trends in these verticals, if you can explain some qualitative aspects over here.
Can you just repeat that question again?
So fintech and transportation and logistics vertical, if I compare the first half FY25 revenue versus first half FY24 revenue, then it seems a 10% decline in both the verticals on YOY basis, first half to first half. So just trying to understand the demand trends, maybe some demand headwinds in this verticals, if you can specifically highlight.
Fintech has gone down because there has been a little bit of some challenges for us in our biggest account there. There's been some changes in the organization of our customer, some reorg, which has deferred spending, but that's going to pick up in the second half of this year. So I think these are temporary blips which will get corrected over the next 6 months. I think over the next 2 quarters you should see this correcting out.
Okay, understood. And third question regarding our recent acquisition, Septis. So can you give some color about its margin profile and what are the synergies do we expect from this acquisition?
The biggest synergy is our building of capability on Salesforce. If you're familiar with the Salesforce platform, it is used by most medium to large enterprise organizations. And our target market is the mid-market, companies which are 200 or 250 million in revenue to $2 or $3 billion in revenue. A lot of them, I would say almost 75% plus, use the Salesforce platform. We are now going to be able to offer them, capabilities in this space. It's a fast-growing market. It's a fast, developing market. You would have heard of, most people when they talk about Salesforce, they think of CRM. But Salesforce is not only CRM. CRM is the marketing cloud or the sales cloud, but they also have a service cloud. They also have a finance cloud. They also have a commerce cloud, and they have a data cloud. And these are all very integral parts of today's focus. And most importantly, they have an AI part which is called Agentforce. We're seeing a lot of interest in that space, and you will see in the coming quarters our focus on artificial intelligence and AI and how that is changing the game, for our increased farming of our existing customers as well as reaching out to new prospects. So Salesforce is going to be, from a Septis perspective, a big feather in our cap from a capability perspective. In terms of margin, it's about 15% EBITDA margin. We are confident of taking that up to 20% plus because we'll be able to take those services to a lot of our existing customers.
Okay. Yeah, thanks a lot for answers.
Welcome.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Miloni Mehta from Monarch Networth Capital. Please go ahead.
Yeah, thank you for the opportunity. So in this quarter, we see that the EBITDA margins have been a little on the lower side when we compare it even on year-on-year basis. It's mainly because of increase in employee cost. So I just wanted you to throw some light on that. And also, how do we expect it in H2?
The only reason for muted EBITDA has been the increments. We gave the appraisals and the increments to our workforce, to our employees, effective
July.
So 1st July. So that has had an impact this quarter. It will get corrected. Normally this impact happens in the first quarter. Okay, this time it's got, this year we've deferred it to the second quarter. This will get corrected out in the next 6 months.
Yeah, so now September is contributing 15% to it. Will we see number higher to 18% as to what we are targeting, or it will be in the range of lower to like 17?
Between 17 and 18 is what you can expect for the full year.
Okay. And contribution from Augmento, and what is the run rate that we see moving ahead?
Augmento contributed 8 crores of top line in this quarter. 8 crores. Yeah, go ahead, Neeraj.
Yeah, so the total contribution from Augmento was around 12 crores for this quarter, and that we are expecting it to be the run rate.
Okay, thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Rohan Mehta from Bunaf Investments. Please go ahead.
Thank you for the opportunity, sir. So my first question would be, how much can we grow our sectors over the next few years?
Say that again, please. How much can we
grow the sectors over the next few years?
There is a lot of opportunity in the Salesforce space. Now, how much can we grow? It's a difficult question to answer, because what Salesforce will do is it will not only allow us to offer Salesforce capabilities to our existing customers, we'll also be able to open new accounts through this capability or through this offering. So, and we might, when we open that account, we might sell many things other than Salesforce. So it's a difficult question to answer, but in summary, what I can say is it's a very essential part of our capability build. All our acquisitions so far have been capability-driven acquisitions. This is also one more capability-driven acquisition. It will add to our capabilities, which will add to our ability to farm existing accounts as well as open new prospects.
Okay, sir. Got it. And so my next question would be, earlier we had given a guidance of 1,000 crore in revenue terms for FY25, and till date we've achieved close to 416 crores out of revenue. So are we sticking to that guidance, or is there any alteration in that?
As of now, we are sticking to the guidance. It's a tough target. We're going to try and get to as close to it as possible.
And so what would drive that growth?
So, your voice is not very clear. Can you repeat it?
So what would drive that growth?
Existing customer growth, like I said, we've got another $2 million plus customers. If we can grow them rapidly, that will help us. Existing customer pipeline is picking up momentum. There's a lot of activity in our sales pipeline. We've added sales teams, in the last call you would have heard, we've added sales teams in the US as well as in the UK. It takes time for them to, add to the pipeline, bring value, bring sales. That momentum is picking up. So organically, the engine is starting to, show results, and that engine, we're very confident will pick up momentum in the coming quarters. Now, 1,000 crores seems a tough ask today. It's going to be, something that we are still aspiring for. We're still pushing our teams. Let's see how close we get to 1,000 crores. But that's still our goal.
So just last question, sir. Will H2 be better than the H1?
Of course.
Okay, sir. That's
Thank you. The next question is from the line of Pratap Maliwal from Mount Intra Finance. Please go ahead.
Hello, am I audible?
Yes.
Yeah.
Yeah, hi. Thanks for taking my question. So, sorry if I missed this out, but did you point out the revenue base and the PAT margins of the recent acquisition of Septis? What is their revenue base?
Their revenue base is around 20 crores and their PAT margins is in the range of 12%.
Okay, understood, sir. And just one confusion I had regarding Augmento. You initially had said that the contribution for this quarter was 8 crores, and then you said the total contribution was 12 crores. So how much did Augmento actually contribute in our incremental revenues this quarter?
Yeah. So what we had meant was, the question was, how much of the increase came from Augmento? So the increase which had come in from Augmento, because that was acquired in the month of June. So we had some revenues which had come in from them, around 4 crores of revenue which had come in the previous quarter. And current quarter's revenue were 12 crores. So the incremental revenue on account of Augmento was 8 crores and the total revenue from Augmento was 12 crores. Hope that clarifies.
Okay, so Augmento revenue in Q2 was 12 crores, is it?
Correct.
Okay, and I just had one question regarding Augmento. So, like we call it, it's part of our digital engineering offering. So, what exactly is our offering here? What problems do we solve for our clients? What is the use case that, Augmento kind of brings in for the clients?
It is the entire SDLC. When we say digital engineering, it is, application development, product engineering, product sustenance, product support, enhancements. The entire life cycle of software development is what we are referring to in digital engineering. And today that is a hot area, not only because of the large number of spends in this space, but also because of artificial intelligence. So we have a number of frameworks in the company. Augmento also contributed towards that, which are helping us get business in the digital engineering / product engineering space.
Okay, and just finally, what is the amount that we are paying for the recent acquisition of Septis? What is the acquisition amount?
The overall consideration, including the earnout, will be in the range of 62 crores, about.
62 crores.
Yes.
Okay, sir. Yeah, got it. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Vikas Srivastava from RBC Financial. Please go ahead.
Yeah, hi Aditya. A couple of questions, a little bit on Septic. While I understand the potential in terms of integration and hitting the ground running, where are we in terms of, is the acquisition complete in all respect, and will there not be a gestation period between now and maybe 3 months, 6 months before the results from Septic start coming in?
Hi, Vikas. Because these are small businesses. These are not large businesses which require major integration efforts. Predominantly, what is the integration? It's the accounting, the finance part, which is very easy to migrate now because we're all on, Microsoft Dynamics. So whatever Septis is or, the company we acquire, we quickly, within a month to 5 weeks, we're able to migrate them to Microsoft Dynamics. So that's one part. Then the front part, which is the CRM, the sales pipeline, we use an in-house tool called SACtrack. That's something where our timesheet system is, where our sales pipeline is, CRM is. That is also effective 1st November for Septis. So integration has happened. The teams are working with our sales teams to take this offering to existing customers. So we have hit the ground running. There's going to be no lag from adding that capability to our set of offerings.
Okay. My second question was on Augmento. You were projecting a flat contribution. When we bought Augmento, there was a potential which you estimated. But quarter on quarter and next 2 quarters, we are still talking about 12 crore contribution per quarter from Augmento. Is that a conservative estimate? Is there an upside risk to that number? Where are we on that? Or are you just giving me extrapolating it on a flat basis and telling me that, okay, this is the minimum we'll do?
Augmento is contributing about 4 crores a month to our revenue.
Correct.
And that is something that, we can take for at least for the next 6 to 8 months.
Okay, so you're saying that that will remain more or less stable at 4 crores a month for the next 6 to 8 months. One doesn't see any major upside on that.
Not immediately. Like I said, there are $2 million accounts in that customer. We are mining those accounts. We will see improvement, but we're not factoring in it. I'm just saying that for now, let's take 4 crores a month from Augmento.
Okay. Aditya, the next question is on first half versus second half. We've done about 416 crores. I could have my figures wrong. If you're still targeting, we're talking about another 580 crores in the next 2 quarters. We are into November, which means that out of the 6 months, 1 month is already gone. So we have 5 months, actually 4 months and 20 days left in this quarter. At these kind of numbers in terms of, and you're still holding on to your bold call or at least a target, which you're admitting that it's not an easy task. But in terms of, you make sure have some visibility, right? You have 40 days in this 6 months is gone. What is it, the kind of bag? What is the range out of this? We're still targeting 1,000 crores. What kind of a range are we talking about? What is the downward risk to this 1,000? Is it 10%, 20%? How much of it is already in the bag? And considering that, we have invested in the sales force. Now this investment has gone on for a while, and things have been in the pipeline. There should have been, is it reflecting in an already existing crystallized order book, which we have to execute on the last 5 months? Because there has to be a time lag between new orders and delivery in the next 5 months. And if you can give it a little more color on where you are getting your ambitious confidence or this very stretched confidence, where is it coming from? Then what's the comfort level? Where are we on this? How should we be looking at it?
Vikas, if you remember in our last call, you asked me this question about sales teams. Are the guys we've hired still with us? And I told you that they're all with us. Most of the sales guys joined us in this financial year, the new sales guys. Maybe one joined us at the fag end of the last financial year. It takes time for these sales guys to show results. They have to understand the company. They have to understand our target market. They have to understand our offerings. They've started to add pipeline. They've started to add momentum, which is why I've been saying that we're seeing increased levels of activity in the pipeline. And we saw one big win of a large high-tech company in California recently, which we added to our logo, and we're very hopeful that there will be more. So, organically, it takes time to build the momentum, and I'm very confident that it's happening. Can it be faster? Yes, it can be faster, but it's happening. That's number one. Number two, on the range of revenue, you're right, 1,000 crores is an ambitious goal. I don't want to let it go, Vikas, because letting go is the easiest thing. If I say, and everybody's listening to this call, including the sales team. If the minute I say that we're we're letting go of the ambitious goal, I can guarantee you that forget that goal, we won't even hit the lower end of the range. So the range that we're looking at, and I'll be very upfront with you, is on the downside we're looking at anywhere around 870 crores, which is about 100 crore more than last year. And on the upside, I'm still sticking to around 1,000.
Okay, fair enough. So you're saying that 870 to 1,000. So but currently, if you are doing, correct me if I'm wrong, we have done about 416 in the first quarter, right?
Right.
First half. So we are now looking at anywhere between 870 to 1,000 or somewhere in between or whatever, and hopefully 1,000. But you're saying 1,000 is not, it's still within the realm of possibility. It can, in terms of structurally, in terms of delivery, in terms of time lag between, and are you factoring in more acquisitions in this number in the next 6 months? Is there a possibility?
Yes, there is possibility. We are working on a couple of deals, but again, these are not going to be, we don't have that much money. So these are going to be small deals, because
so you're
to deal.
Yeah, sorry. Just so therefore you're talking about these numbers more or less coming wherever they come from, mostly organically.
Correct. And we have to fix that problem of organic growth. See, acquisitions only hide the problem. We need to fix the problem of organic growth. And that is where I'm spending all our time, my team is spending all their time, because if we can fix that problem of momentum in our pipeline, then next year, the year after, doesn't remain a problem. It's the first hump we have to get over, which is give confidence to the sales guys, make them successful so that they stay with the company, make sure that all the muscle is behind these sales guys so that they're able to grow the business, existing accounts, new prospects. Once that starts kicking in, then the momentum takes you forward. If we keep adding acquisitions,
Got it.
It just it gives you a short-term kick, but it doesn't solve your problem.
So can we therefore say that about 870 is, we have those signed contracts and other things remaining the same and any mishap here or there? Can we say that 870 is in the bag?
Yes.
Assuming there are no aberrations?
Yeah, you can say that.
Okay. And typically from, in all our digital, if I ask you for a general rule, typically if you get new contracts between now and the next 1.5 months, till which month do they still kick into the revenue? Now, what is the time lag between signing a contract? And I'm asking you a very difficult question. And between signing a contract and actually converting into revenue in the financial year, what would be your cutoff date beyond which the new contracts would spill over into next year?
I would take a guess at about 3 weeks. So if I was to sign a contract today, we should be able to take some revenue within 3 weeks.
Okay, the time span is so short, right?
Yeah, very short, because we are a focused niche player. We are offering services for which we have capability and resources available.
Got it. If that be the case, why are we, in terms, isn't our EBITDA forecast of 17? I'm assuming that as of now, of course, wage hike has happened. Are we planning to hire more people in the sales force in the next 6 months? Or are we going to just wait for some returns this year? Why is our EBITDA margins or forecast still 17 to 18 in terms of operating leverage and scale, whichever way, whatever you want to use? Should our EBITDA margins not be above 18 then? What is stopping it from being above 18? Or is it possible? Is it possible, or is it again that's not possible, or am I missing something?
Very difficult above 18% because historically what has helped is the rupee dollar. That's not happening. Rupee dollar, or the rupee weakening is not happening to the extent it has happened in the last 5-6 years. So I think 17-18% is probably the max for us from a growth perspective. Because keep also in mind because that we need the business. So when we go into a new prospect, we might compromise on our rate card because unless we're in the game, we can't grow the business. So we will, whatever it takes, we will get into that account, even if it means discounting, even if it means giving something away for free to enter that account. Because once we're able to demonstrate the value we bring, then at a later stage we're able to raise prices. And the customer's also okay. Customer's also judging us. So you will see over the next 2, 3, 4 quarters, you will see a great impact of how AI is changing our business. And that is where a company like Saksoft is very well positioned versus some of the larger companies. They have much more to lose because of AI. AI is a disruptor. Now, when there is a disruptor, market leaders lose the maximum. And we are not a market leader by any stretch of imagination. So we have the maximum to gain, while the others have the maximum to lose. And that is what we're going to capitalize on. It's a bet we're going to take. And you'll see that in the next 2, 3, 4 quarters. I'm very hopeful and very motivated and encouraged by what we see on the AI front.
So I would like you to spend a little more time, Aditya, and explain this to us, me and others on this call a little better in terms of this opportunity and the logic. I may be a little handicapped to understand this better, but others might, and maybe if you elaborate on this, it might.
Sorry to interrupt, Sir Vikas. I just request you to return to the question queue.
Okay, I'll do that.
Yeah.
Okay. Thanks.
A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Namaskar, Aditya ji, and thank you for the opportunity. Am I audible, sir?
Yes, sir, you're audible. Namaskar.
Yeah. Thank you. So when we look at our first half performance and at the segmental revenue, we have seen the growth coming in the high-tech media and the utility segment, and fintech, transportation remaining lower, retail e-commerce getting a big bump. So if you could just explain how are these verticals likely to look like for H2, and secondly on the other expenses line item also, when we see the first half, those have gone up from say 20 crore to 34 crore. So are they variable costs? If you could just explain the nature of the same.
I'll answer the first question on the vertical. Our biggest vertical today is high-tech media and utility, and that is where you will see the maximum growth in the coming quarters. We are very bullish about high-tech. There a lot of spending is happening in our biggest market, which is the US. Also, our capabilities are best aligned towards high-tech, again because of the advent of artificial intelligence. So in the next half as well as the next year and the years ahead, high-tech is probably going to be the largest vertical for us. What is going to catch up is fintech. We've had a little bit of a setback on fintech, as I explained earlier. Our largest customer has had some changes, so they've deferred spending. That'll get corrected, over the next few quarters. But fintech will catch up. E-commerce and retail also we see as a huge spend pool because companies are spending more and more on e-commerce. They're transforming the platforms on which they're working. Okay. Logistics has had a rough year because there has been a consolidation in that space in the US market. There's been a lot of bankruptcies in that space. There is a shakeout. It contributes about 16% of our revenues. I don't see great growth in that, but it's a sector where we have a lot of expertise. It's a sector where we have a lot of domain knowledge, and I'm confident that in the coming years it will also start showing an upward trend. So that's as far as the verticals are concerned. You had a question on the expenses. Neeraj will answer that.
Sure, Aditya. So what you see on the expenses line when you're referring to an increase from almost 20 crores to 34 crores, this is predominantly because of our retail e-commerce vertical. In that vertical, we have a very strong partnership with HCL Commerce. And as a part of the revenue which we generate, there is a component of the license of the HCL Commerce platform which gets sold to our customers. So the cost associated with that is not captured in the employee line. It gets captured in the other expenses line. So that is a cost which is proportionate to the revenue, which is the main reason for the increase.
Okay. And sir, we have also seen our finance cost and there is also moving up significantly from the first half. It is equal to what we paid last year. So if you could just explain, these are the bank charges or what could be the reason for this increase, and then two follow-up I have.
Sure. See, the finance charges, what happens is, as you know, when we do our acquisitions, there is an upfront payment which is involved and there is a deferred payment in terms of earnout, which we pay over the next 2 years. These payments which have to be paid in the subsequent years, from an accounting perspective, gets classified as financial liabilities, and they have to be fair value to the current date. And you'll have to do a interest reversal over it over a period of time. So predominantly these are hypothetical interest charges, which are the unwinding charges in relation to the future financial liabilities which we will incur. That is the main component of this increase in the finance costs.
So these are only provision entries and not actual cash outgo as of now.
Yeah, predominantly not. What will happen? The actual cash outflow will happen when the earnout payments happen to the founders when they meet their targets.
Okay. And for the other income component also, sir, we have seen that rising gradually. Does it have any proportion to the rupee dollar equation, or what attributes to this doubling of other income for the first half?
First half, I think whenever you look at previous year, it becomes very challenging because in a IT company, it's more sequential, quarter on quarter, which you need to look. But definitely the exchange has been a little favorable, especially if you see the GBP movement which has happened in the current year. It has gone up significantly. So a large chunk of it is predominantly exchange. Plus, because of some of the treasury-related operations, the idle funds which were invested, they have also given some better results because of the higher rates which are available in the market, either in terms of FDs or mutual funds. That is the main reason for the increase in the other income side.
Right. Sir, can you specify what is the cash on book? Ma'am, just this question has joined us.
Okay.
Yeah, the net cash on book as on date is around 150 crores.
100 crores. Okay, sir. I have a couple of questions on the verticals. I'll join the queue and respect the time. Thank you.
Thank you. The next question is from the line of Meet Raj from Equirus PMS. Please go ahead.
Yeah, thanks for the follow-up. So, from a capability standpoint, we have recently concluded the Saptis acquisition to gain Salesforce capability. So, just trying to understand what is the next set of capabilities we are trying to target in terms of our hyperscaler partnerships, network, etc. Maybe from acquisitions not in this year, but let's say in FY26 or FY27.
We're looking for an acquisition. I know you guys have a M&A team. So we're looking for an acquisition, a strong Azure Microsoft Azure partner or a strong ServiceNow partner.
ServiceNow and Azure.
Yes.
Okay. And sir, coming to Q3, so in terms of furloughs, do we expect the seasonal furloughs to be there as usual, or there is any change in the furlough pattern this time?
You're asking me a question: is Christmas going to happen this year or not? Of course, there will be furloughs.
No, so in our 2 to 3 peers, what I have observed is in some of the verticals, furloughs have been preponed to Q2. That would be maybe client-specific thing, but in general terms, you are expecting furlough to be as usual, right?
Absolutely.
Okay. And what was the attrition for this quarter, Q2?
13%.
Okay, thank you.
Welcome.
Thank you. The next question is from the line of Saket Kapoor from Kapoor and Company. Please go ahead.
Yes, sir. Thank you for the opportunity again. Sir, looking at our verticals, you were mentioning that we are looking for growth on the higher side, especially for our high-tech media verticals. And how is this transportation and logistics verticals looking like in terms of the deal pipeline? And as you mentioned about AI, we did read an article today in a leading business newspaper, which also alluded to the fact which you are articulating to, that mid-sized IT firms are at an advantage, and they have also named one of the organizations, so it's in public domain, Sonata Software, getting $100 million deals also that has been aided by AI. So are we also guiding to that part of the story which you just Aditya mentioned about AI being a big enabler in getting larger size deals going ahead?
Yes, AI is here to stay, and AI is an enabler for anything in technology, from development work to infrastructure work to customer service work and to infrastructure work. So I don't think any technology company can hide AI and how AI will disrupt their business model in the coming quarters and the coming years. We are no exception, because we are a niche player. We are a tier 3 supplier. I would even call ourselves, at the lower end of tier 3. We have the maximum to gain, and that is what I was telling Vikas earlier. We have the maximum to gain, because when there's a disruptor, the market leader loses the maximum. So we are very bullish on AI, and we are working extremely hard to see how AI can complement what we offer. That's number one. Number two, we are using partnerships very extensively in each of our verticals to help our lead generation and our new customer acquisition. So for example, since you brought logistics, in logistics we are looking at partnerships with Clio, which is an integration tool. We're looking for partnerships with CargoWise, which is a TMS supplier. A partnership with MercuryGate, again a TMS supplier. So these partnerships will help us open new accounts as well as deepen our footprint in existing accounts. And we're working on partnerships in all the other verticals. In retail, Neeraj already mentioned we have a very strong partnership with HCL Commerce. We also have a strong partnership with Adobe on the commerce side. On the fintech side, we're looking at partnerships with Plaid, with Modern Treasury, with nCino, with Q2. And high tech, we're looking at partnerships with Talkdesk and a few others. ETC as an example. So you will see a lot of our focus will be on partnerships so that we can add not only new logos but also deepen our relationships with existing accounts.
Right, sir. And sir, one small understanding, and correct me here, if in our presentation also we could provide some more insight on the type of, on the number of acquisitions which we have done over a period of time and how have those contributed to the revenue and the profitability, that would suffice a lot of our questions. And also going ahead, whenever we acquire, since we are in the foray for acquisition, we will grow by both organic and inorganic. So if you could present a slide in the presentation, that would be very helpful for us, so that a like-to-like comparison can be easily drawn.
What will be very helpful for us is if you, since you are attending a lot of these calls, if you can give us a sample of what you mean, we will definitely include it.
Yes, sir, I can take offline. I will
Thank you.
definitely discuss. I'll try to give my side of it. Thank you, sir, and all the best for the very insightful discussion and giving us opportune time to discuss the same in length. Thank you.
Thank you. The next question is from the line of Udit Kanodia, an individual investor. Please go ahead. Yes, Mr. Kanodia, go with the question, please. As there is no response from the participants, we'll move to the next. The next question is from the line of Vikas Srivastava from RBC Financial. Please go ahead.
Hi, Vikas.
Sorry, I'm back. So the earnout, I understand, is that finance earnout, future potential earnout at, assuming that they meet their targets, have been already accounted for in the finance cost. Is my understanding right?
No. Because it's needed, just to clarify what we meant is, since there is a liability to pay the earnout in future, that liability is accounted for in the books, and that liability is fair valued. Let's say if we have assumed that we need to pay 50 crores at the end of 1 year, using the current market rates of 8 to 10%, you would fair value it at around 45 or 46 crores currently. And the 4 crores would be unwound as interest expense over the year. That is what I meant.
So, okay, can I ask that question? Therefore, are you saying that approximately 70 to 80% of your potential earnout liability has been provided for?
The 100% of the potential liability is sitting in the balance sheet as financial liabilities. We have to provide the liability for the future estimated payments as a part of our financial statements. So whatever best estimate we believe is the earnout which is going to happen, that is already provided in the balance sheet. So if you look at the liability, there will be two components under both the non-current liabilities. Financial liabilities will be there, and under the current liabilities there will be financial liabilities. So all the amounts is already provided.
To provide a credit for liabilities, you have the debit has to hit the profit and loss account, right, Neeraj? So my question is that if you don't make, and okay, let me put it simply, if you don't make any more acquisitions, this financial liability which has come in this quarter, this financial cost, will come down significantly from next quarter onwards. Is my understanding right?
That's correct.
That's what I wanted to know. So that was one. My second question was, what's the breakup of dollar, euro, and the pound sterling breakup of your turnover today?
Dollar will be based on what we see in the GOI. So roughly 45% will be the dollar denominated. Pound will be almost 25%, which is more or less the geo breakup which I have provided. So all the euro which you see is predominantly GBP. So that's around 23%. And the balance would be INR and Singapore dollars, which is the 34% from the Asia Pacific.
And when you make forecast or whatever estimate of your EBITDA, specifically for dollar, are you considering your past rupee not weakening enough, how do you put a rupee conversion or exchange rate number to that?
See, it's a very difficult calculation because, to be very frank, the only thing which we try and do is we can't really estimate how much it can depreciate or appreciate. But from an exchange factor perspective, what we do is we take forwards and we cover more than, nearly 50% of our exposure for up to 12 months. Earlier we used to cover up to 6 months. Now we cover up to 12 months. So that whatever estimate we take in the beginning of the year, at least 50% of that holds good.
Got it. And if the rupee weakens significantly, there's an upside there.
Absolutely.
Okay. My next question, I'm coming back to Aditya. Aditya, on the AI, and I think this is my last question. In terms of AI enabler, are we saying that we will be using AI to execute better and sell better? Or are we saying that because clients are getting disrupted by AI, they will need us more? Would you just elaborate on that, please?
Yes. 55% of our revenue, 50% of our revenues comes from digital engineering. Digital engineering is the most evidently impacted by AI. Now, I'll give you an example. Quality assurance or testing is a big part of the software development life cycle, or what we call digital engineering. I mean, these are, words or phrases which are used interchangeably: product engineering, digital engineering, SDLC, etc. Now, testing is a big part of the SDLC life cycle. We have developed a tool called Saksoft. It is a AI test case generation. It uses AI to generate test cases, which were earlier done manually. It saves 40% effort. Now, we can go to a customer of Persistent and say, look, we can do what Persistent is doing for you at 40% less because of this tool. Okay. Now, Persistent is also doing the same. It's not that, we are flying the space shuttle or something that they can't fly. It's just that, for them it's cannibalization. For us, it's new business.
Got it. So the smaller and people who are more hungry, who are growing, are in a better position to use. So basically, how you can deliver more value to your customers in terms of execution are these products, AI-enabled products, which you have developed or are developing internally, is where you get an advantage over others, because obviously, if Persistent psychologically, right? If somebody, like, let's not name any company, but if your competitor, which is larger, he needs to then probably, and change is always very difficult. So in terms of reducing people, manpower, systems, and getting psychologically used to the idea of charging 40% less without it actually improving their margin really is where your advantage is.
Yes.
And that my follow-up question would be that this is what we are using, and in terms of sales effort, we would be at par with another Persistent or anybody if you are using it. It's more on the execution side where the benefit comes. Yeah.
On the sales side, larger companies would have an advantage because they obviously have larger sales teams. We have smaller teams. So we would be on a back foot vis-a-vis larger companies there. But from a value perspective, we will be able to demonstrate better value.
And that there is a lot of the proof of concept, and in the last 6 months, just let me complete this question, please, and I'm done. I don't think that too many people would be waiting. So, from this entire process and flavor, is there something that you've already kind of tested and established and you're seeing very positive signs here?
Yes, because we have these frameworks ready. So TestVerse is an example of test case generation using AI. On the development side, we have something called fact filing, which is used like Microsoft Copilot. It helps in the development cycle. So these frameworks are in place. We can demo these frameworks to prospects as well as customers. So what I'm talking about is not vaporware. It's actually in place.
Got it. No, that's all from me. Thank you.
Thank you. Ladies and gentlemen, as that was the last question for the day, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
We thank everyone for taking our time to participate in this call and for their interest in Saksoft. I hope we've been able to answer some queries, and in case you have any other queries, please reach out to us or our investor relations advisors, valuation advisors. Thank you everyone for joining us.
Thank you. On behalf of Monarch Network Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.